Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon to all. This is another episode of the Weekly Notebook Review. I'll let a few folks trickle in here, and then we'll get rocking and rolling. It's Wednesday. The Bulls won. The Bulls really took a steamroller to that action today, hey, John? But anyway. All right, well, let's get right into it. So, Weekly Notebook Review. This is May 17th. It is approximately 4:30 on the East Coast. This is game 94. What a game it was, and what an opportunity presented. So, hopefully, folks, stuck to their process and executed. I know I certainly, did. Although I thought I was executing pretty well, going into like 12:30 p.m. and then boom. And then the good old freight train came a trucking along, but that just gave us an even better entry point. I mean, hell, if I liked XLK at 153 or what have you, I certainly liked it at 154, right? Where was it? Where was I adding to it? So yeah, it's about 150. Yeah, about 153 and change. I liked it there. I liked it even more at 154 and a quarter. So anyway, we got a lot to talk about. For those that may be new to this process, this is the midweek review where we dive into the notebook. We talk about signals, we talk about process, we talk about kind of what we're seeing on the page and areas of opportunity and areas that may either been working, either on the long side or the short side, and the signals getting either a little stronger or a little weaker. So we're kind of trying to help set up for tomorrow, but also and more importantly for kind of next week, next month, next quarter, and what's coming down the road. So for those that have Macro Pro, you hopefully or have listened to the macro themes update for the mid-quarter update from Keith and Steiner. But if you haven't caught that yet, really the big takeaway is really the title of this spaces, which is beware. The sinkhole is developing. So Keith's been talking about it in the early look, the macro show. It really shouldn't. You shouldn't really be surprised by what we're seeing on the horizon from the data that's coming in. And so again, I mean that's kind of the reiteration here. This is the so 14% of the S&P, just kind of repeats one of the early look this morning, but I think it just really needs to be reiterated, right? It's 14% of the S&P is made up of Apple and Microsoft, so two of the big behemoths, and then Apple's market cap is as big as the Russell. So Russell, which is just absolutely kind of crazy to think about that one single security or company could have the same market cap as thousands of companies put together. So again, just kind of let that sink in. In terms of stuff that's jumping on the page, oil continues to absolutely work. I think you got a great opportunity there today in terms of kind of adding back to it on the short side. Again, just before I kind of get into sort of the rundown, I do want to just reiterate, and it's something that Coach was reviewing and talking about in his coaching notes during RTA, his RTAs, his real time alerts today. We don't really talk about kind of like the covering or what I will tweet out as paying yourself. It's really important to pay yourself. Making a good trade is hard, whether it's on the long side or the short side. So don't forget to kind of pay yourself. We call it kind of incrementally, adding to or subtracting to inventory, pieces of inventory or what have you. But I think this is, if you did execute kind of on Friday, on some of those lows for things that were working on the short side, like industrials and even industrials, financials, KRE, energy. I mean, the list is quite long in terms of the cyclical type companies that really have been quite weak, and those signals to the downside continue to look very good. But again, if you didn't kind of like cover some in the days leading up to this, so kind of that back half of last week, maybe even earlier this week, then you didn't give yourself an opportunity to kind of be there on a big market move day like this, like a non-trending and episodic type move, where the S&P was up over 1%, and right to kind of the top end of the risk range. So that refreshed risk range for those that didn't see it in RTA was 41.61 today. We closed, I think, pretty close to that. Yeah, 41.58.78. So pretty much right near the top end of the risk range. That's a great place to execute. We've been seeing kind of some lower, again, if you kind of zoom back out there, I wouldn't be a lower high day over day. Yeah, it would be actually. So it was a lower high this morning. I just didn't know if that refresh one was. So yesterday's was 41.70. So that's still a lower high. Where we closed today was kind of a lower high on that risk range. If you zoom out a little bit, we are still certainly below those late January to the February 2nd peak, which I think I talked about last week, which was 179 spot. Sorry, 41.79 spot 75 is where we closed on February 2nd. So we're about call it 20-ish points away from that. And then obviously you get the prior very significant high, the most recent other highs from the cycle would be from late August there, and that's all the way up at almost 4,300. So again, these are just to kind of reiterate and to kind of take it back in a little bit bigger picture. This was again, I'm just going to say it again. This is a great opportunity to execute today. We saw a lower high, although it would be a not quite, yeah. So we didn't even make a 1 month high from May. I think that was May 1st, the other 2 weeks ago. No, excuse me, end of April, February, April 28th, I believe was the most recent high, either that day or that Monday. But so not even a 1 month high on the S&P. So although this may have felt like a bit of a freight train, midday. When you look back and you look at kind of the price volume and volatility components, it's all setting up right there for this sort of sinkhole that's developing, the economic data that's rolling in. Reality is going to have to be reported. Q2 earnings are really around the corner. This was the mid-quarter update, so we're truly mid-quarter here in mid-May. So again, just kind of just depends on your time horizon, that kind of stuff. It doesn't mean that you shouldn't have longs in the portfolio, right? And at VIX sub 20 or certainly sub 19, that's the top end of the investable bucket. And realistically, it's been acting quite choppy. So we'll just kind of call it still in the chop bucket. We're kind of up one day, down another, down a little bit more the next day, then kind of up 1% the following day. But these numbers are right in line with volatility. I see my boy Chris Moyer out there, 1000 FX, who sat down with Mike Green on Sunday. If you haven't listened to that Spaces, it was a fantastic hour and a half or so conversation between two very, very knowledgeable folks. So great work, buddy. But my point is that he reminded me of the rule of 16. So we closed at 16.86 on the VIX, and we were up a little over almost 1.19%. So the math, that means we can go up one or down one. So just keep that in mind, right? You want to make sure that you're kind of short up the long side of the book as well as the short side. If you can go long short, some of those longs out there today. I mean, Coach was certainly adding to things on the long and short side inside of real time alerts, and a lot of the very prototypical or I guess typical kind of quad four names like healthcare, precious metals, some fixed income, and utility staples, that kind of thing. So so just kind of wanting to reiterate those facts. I think the other big move that we have been, which I think is kind of great to see, is the dollar. And so you're seeing higher highs and higher lows in the USD day over day, and big higher high in that 102.90 versus 102.76 yesterday. Still neutral trend, but certainly bullish trade. And again, let me just pull up that level because I have it in my sheet. But so that trade line, just so everybody kind of has it written down again. This is from the 15th, from Monday, I guess that was 101.49 is the trade line on the dollar. So we're right at the top of the risk range. If you if you didn't sell your dollars, you're back to bullish trade, but bearish trend. So again, I would kind of keep that on a tight leash, maybe lighten some up here with an opportunity or kind of perhaps an expectation. Actually, expectation is a shitty word. So just like, taking advantage of an opportunity if it does pull back down to kind of that trade line of 101.49. Now that trade line does shift, right? Because it's influenced by price, volume, and volatility. But that's just what Keith reiterated to us on Monday. So just wanted to kind of reiterate that to everybody there. I think that dollar move is really interesting, as well as the breakdown in the euro and the pound. It's so really great, or not great, but just sort of is it possible that we kind of see a redevelopment here of sort of a traditional quad four long dollar, short the euro, maybe short the pound. I know. So let's just kind of see how those signals kind of march out there. But right now, the big one is the fact that it's just at the top of the risk range. I mean, it closed at 102.894, and that top end was 102.90. So I certainly was. I did add some cheeky UUP calls last week, and those paid out today. So that was good to. So I was a seller of some of that dollar, which helped offset some of the losses on the short side. But hey, we don't need to get into that. The other great thing too is that that US dollar correlation continues even with this sort of dollar strength. It's really the breakdown is still there with gold. We're down on to a negative 0.36 on a 15-day correlation to gold. On a bit longer term, 30-day, it does creep up to negative 0.42, and then as we kind of expand that on a quarterly basis, so 90-day and the 120, we are up above negative 0.80, so 883 and negative 0.89 respectively. So keep an eye on that US dollar correlation. I think that's going to be an interesting one to sort of watch and pay attention to, as either the dollar kind of regains some strength, or and as well as kind of what kind of gold does here too. Gold was right near the bottom of the risk range. I don't know where that one closed. Sorry, sometimes right after the market. 1986. Low end of the risk range was 1980. So that one again, we hit buy on suppression metals and both physical and GLD, the ETF. That again, that makes perfect sense if you're following the process. You write it down to the bottom of the risk range. It's core asset allocation. It was reiterated as a long in our mid-quarter update today. So again, this is kind of how you execute. There was a lot to do today, both long and short side, like a lot. Like this afternoon was very busy, and it's fun. It's fun to have those days, because yesterday was like watching paint dry. Although I kind of forced it and I had a really shitty trading day, but those things happen. You live and learn. And today, being a little bit more patient gave you some great opportunities to execute on the fringes, execute on, the top end or low end of the risk range, respectively, given whether or not you're going long or short. The other thing that I think is really, in terms of as we expand beyond U.S. borders, the continued breakdown in the Shanghai composite, and that very definitive quad four in Q3 that's on the board now for China. I think that's a really continues to be an interesting kind of scenario there, and one that I'd be watching very, very, very intimately. Right, so it's possible that the equities may kind of front run or look past that quad four in Q3, but right now they're looking square into it, and they do not like it. So you do get some quad ones on the flip, I think, kind of beyond Q3 of this year in China. But right now they're having to deal with that quad four and a lot of sort of policy situations there. But the signal, again, if you just look at the signal itself and what it's looking like, it is breaking down. So you did get a bit of a higher low there this morning, but you certainly had a lower high. And then if we go back just like a week ago, which would have been, the 10th? If you compare that, that's a big time lower high this morning at 33.60 versus 33.90 last week. And even that low end of the risk range is basically kind of a little bit unched, call it a little bit of a higher low, but that's just, basically consolidation, a little bit of volatility coming out of that indices at 32.21 last week and 32.36 this week. But the lower high is the really big one, certainly the one that I've circled and starred. So that's Shanghai Composite. The Nikkei strength is just, you will not quit. That thing, like, basically, if you're long it, fucking good for you, and stick with it. Stick with that. Probably I would think you'd be at a minimum sizing at this point. I know coaches, because you only get one choice at when you're at your minimum. You either sell it, or you either sell all of it, or you add to it. Add to it on strength. But the Nikkei just is probably one of the best looking bullish trends out there at the moment. And the DAX too, it looked like it was going to kind of break down a little bit, but it's sort of hanging in. So, there's definitely some other European components that we're much, much more, fond of on the short side. So certainly, energy related European ones like Finland and Norway. And then, Spain and France also creeped up that list as well in the last few days. So Europe, with the euro kind of weakness, again, I think that those FX crosses are very, very important. If they're not on your watch list or something that you're paying attention to, you really got to. That the dollar, Keith has actually mentioned in the past that if he was just stuck in a dark room and all he had was his dollar risk range, then he thinks he could probably trade pretty darn well. The dollar drives a lot of price action across the board, whether it be equities, fixed income, commodities, et cetera, et cetera. So really paying attention to those crosses. And again, you've got a neutral on that Euro USD, but it is bearish trade there and bullish trade for the dollar. So just keep a really keen eye on that. The other, I think, development too there is that slight breakdown in the pound versus the dollar recently. Again, it didn't put in new 1 month lows, but certainly kind of probed the low end of the risk range today, which I thought were pretty darn close to it. And so again, that's very interesting. It didn't close down there, so that is also interesting. Where this could be just a higher low here and a bullish trend, and perhaps it was a buying opportunity this morning. I think time will tell, but yeah, just want to kind of call that out. Silver's risk range is, talk about freight trains. You can drive 2 Mack trucks in a freight train through that thing. It's about over 3 points wide. Silver has broken down. You saw, Coach got out of silver miners yesterday, and he didn't add to it this morning either in the re-rank. So that should also tell you something. Things that he's not doing are just as important as things that he is doing. So we are still long with silver. As I said earlier, and I've said a couple of times already. We are certainly long with precious metals. We think it's a great asset allocation here in this sinkhole developing situation that is happening globally in the global Quad 4 environment. But silver is not acting as well as something like a gold. So keep that in mind there. And yeah, the other places in commodities, that copper just continues to break down. As I said, crude oil gave you a bounce here, and hopefully you were a seller, when it gave you a chance to do so back in, what was that, a couple weeks ago, not even like 10 days ago, back at that kind of 60, was it like 68, 69 level? That was almost at the low end of the risk range, covering some there, re-entering that short here. Again, it wasn't quite at the top of the risk range, but Quad 4 continues to develop, demand continues to slow, and it's pretty much as straightforward as that. It wasn't even up on much volume today as well. So you kind of combine all those things with OVX, kind of sticking around 36. It hasn't really done a whole lot, although it is up 320 points month over month, which is a lot. And I think another reason why it's probably one of our favorite places to go on the short side would be energy and energy related factor exposure. So that was like a 20-minute rundown. I didn't really mean to do that all myself, but there's a lot of friendly faces out there. So if anybody wants to come up, chat with me, we can run through some things that they're seeing. I didn't touch base on Bitcoin yet. That thing just continues to break down. Again, you're going to see a key theme here. What is it, BTC, USD? Yeah. So again, kind of right near the low end of the risk range again. It probed, what was the low end? 25 at 807. Didn't quite get there. I don't think today did it. Not quite. 26,550. So close kind of middle of the range, but again, just continues to put in lower highs after lower high, really. So it was definitely that push in late April in a month end, and then again sort of during that was Friday, May 5th was our Hedgeye Live. I was sitting next to Mitchell Krause and aka Other Side Asset Management. And I told him, I was like, this is a great spot to short some Bitcoin. And boy, oh boy, was I right. If only I had the moment and opportunity to actually put that on into my portfolio. But yeah, that was a good kind of, again, just lower highs. You're seeing a lot of lower highs out there when you kind of zoom out a bit. But yeah, so don't fight the Fed. All right. So, man, you haven't jumped up before, so just kind of want to make sure that you weren't like a troll.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
Hey, Rob.
Hey there.
Hey, thank you so much for amazing meeting update. Really appreciate it.
Absolutely.
I have a question, if I may ask.
Yeah, by all means.
Yeah, so today's action was quite perplexing, Today's action, like you said, free train in the middle of the day. So what explains this? It's really perplexing, because it doesn't make sense. Was it just a AI narrative? Was it just debt ceiling resolution narrative? Was it just Steve Cohen news pump flow? Means what's going on? If you can,
There's a lot of stuff.
Yeah.
So what I saw, there's a big time like zero DTE 5 S&P call order that was filled around 12:30, and that's what I saw. So there was some of the Biden conversation too around the debt ceiling. So I think that sort of added a bit of fuel to the fire, or a little bit of extra gasoline. But really, it was a bit more of kind of like order flow. So you saw again, as I said, a large zero DTE S&P 500 call transpire, like basically get put out there and get filled, I believe, by Goldman. But don't quote me on that. And so that really kind of the dealers just had to rejigger their book, and that drove up the price, and then oftentimes that just sort of one thing begets the other, and all of a sudden you've just got a lot of new basically new calls on the board, and it just really just compounds on itself. So I think today was really almost that simple. Again, you're probably going to see a lot of narratives out there this evening and kind of going into tomorrow morning trying to explain this 1% move. But I'm just going to go back to kind of reiterate what my very good friend Chris Moyer I guess will coach me. Although it's more just he reiterates the fact that at 16 VIX you get 1% up or down moves. It's just part of the math. So this was really although it was a big move kind of going into the afternoon, and if you're kind of at your screen and trying to trade it like I certainly was today, it certainly felt like you got run over. But at the end of the day, it was a very normal price action. So don't overthink it, VJ. If I may, just sort of try to keep it sort of simple like that.
Thank you so much. I really appreciate
Yeah,
that.
man. Yeah,
That was
buddy.
very good explanation.
Yeah.
Yeah.
I mean, listen.
Uh,
At 1 o'clock, I was like, "What the f just happened?" Right. So,
yep.
I
Yep.
was in your same boat, and then luckily, again, I'm blessed with a lot of good friends here within the Hedgeye Nation, and they ping me a lot. And they send me texts, and X2DA4, who's out in the crowd right out there, he shot me basically over a tweet being like, "Hey, there's a large zero DTE buyer out there," and so. So again, it's not always the options trading that drives it, but the order flow is a critical piece to just the market mechanics these days, right? And so again, you don't have to be a wizard or like I don't know all the ins and outs of sort of the how the dealers do what they do and all the zero DTE gamma and all that kind of stuff. But I try to up my game every day, learning more about it, and I'd encourage you to do so. But at the same time, I think listening or sort of executing in the moment and building out your process, whether that's built on a notebook like mine or built in an Excel sheet or through AI or chat GPT, whatever it is that you're using, right? To kind of execute and build out your portfolio, just sticking with your process, right? I think that's the biggest thing in these moments where even if you don't really know what's happening, you're just like, all right, I'm getting an opportunity at the top end of the risk ranges or the bottom end of the risk ranges on XLP, XLU, et cetera, from the long side, gold. And this is just like, again, although it felt like a freight train running you over, it was also like one of these things like hell yeah, right? Like heck yeah, like this is a great opportunity to execute and be ready for the next play and the next game and that kind of thing.
Thank you so much. That's
Yeah,
pretty
buddy.
good.
Yeah, absolutely. No, thank you. Carlos, welcome.
Hey, Robert.
Hey,
Thanks.
how are
Hey,
you?
I don't know if you talked about the dollar yet.
Oh yeah.
I joined a little late,
No
so
worries. Yeah, I did talk about the dollar, but we can go
yeah,
over it. I think it's a crucial signal, so I'm happy to go over it again.
yeah. I mean, I think it's at the top end. I think it finished out close to the top end today,
Yeah. Yep.
and I know it's neutral, and Coach got rid of it, but I don't know. I'm kind of thinking that what will it take? Is it like 3 days or to change? Like a trend, or is it a week? Does it have to be at the top end of the range for like a whole week and then it changes trend, or can you
Good
like?
question. Yeah, that's actually a really good question from a mechanic standpoint. So the risk ranges that we get every day from Hedgeye from Keith, those are immediate term risk ranges. So those are the daily risk ranges. So those are different than the trend. And really, the difference there is the time horizon in which they are incorporating both price, volume, and volatility. So trade is 3 weeks or less, and trend is 3 months or more. And so that really is the main difference. So it's going to just incorporate more. So think about it kind of like as a look back window. So if you go back in time, 3 weeks or less from now was about 15 days ago. So that really incorporates from the dollar standpoint, kind of a lot of that pricing from sort of sub 102 ish, right? So I think the big thing, and he talked about this on Monday, is that it did finish and closed on Friday bullish trade. So it is bullish trade. That trade line, I don't know if you caught it, but that trade line is 101.49. So it is bullish trade, and it is maintaining that bullish trade momentum. Now the trend is a completely different level, right? So that's another kind of pivot point, and that is incorporating a longer term look back. So with price being a bit higher, I don't believe he's conveyed where trend is in the last week or so, but that's going to be a little bit higher. So again, in terms of like when he would shift it, he would shift it back to say bullish trend if one it's above that trend level, and then two, typically he'll kind of let it breathe for a few days. He's said in the past like kind of 3 days, let it confirm above trend and kind of flip it back. But he also, that's not like set in stone. It's just sort of like a general rule of thumb if that helps, Carlos. You're on mute, buddy. Yeah, thumbs up. Perfect. Yeah. So it's less about like it probing the top, or not. It's not probing. It's less about it kind of moving up to the top end of the risk range or kind of moving up on a daily basis. It's more about where those levels are. So it is absolutely bullish trade. That trend level, I'm unfortunately just not totally sure where it is. The one I have actually goes all the way back to January, and but that's not going to be accurate anymore because that was a long time ago.
So it just takes time to, I guess, move trade and trend to, from neutral to bullish or bearish or whatever. Just
exactly.
Times.
Yeah, but so Carlos, along those lines, like it doesn't mean that you can't trade the dollar, right? Or trade the dollar in a bullish trade format. That's what I did, right? So like I bought some. I didn't because. So here's what I did because Keith got out of the dollar. Was that about 2 weeks ago? I did not add to the underlying, but I bought calls on UUP, right? So I played it because it looked like it was kind of hanging in there, and again, just sort of like other components within the FX space, it just looked favorable to me, and therefore, and again, it was purely more of like a trade play, right? Because I was like, okay, it's neutral, which really means it really signals like more of a wait and watch, situation. That's typically, that's really what neutral says. It's sort of like, just listen, it's kind of Switzerland. It's no man's land. Just wait and watch, let it figure out what it wants to do. And I think that's another piece to answer your question, is that because it's neutral, it could go back to bullish, or it could go, bearish really at the end of the day. So right now it's on its way back to bullish, but that doesn't mean it's going to hold there or stay there. And in terms from like a trade standpoint, I bought some calls and I sold them today. So this is another piece in terms of just, having your process so that you can kind of make decisions, rooted in our Hedgeye process, right? And guided by, Keith and the team and all that kind of stuff at Hedgeye. But at the same time, you're making the decisions that you're comfortable with making. And, that trade could have easily just gone the opposite way, and the dollar could have continued to break down. And I basically would have hit my stop loss at minus 45%, and I would have been out that money. But that's sort of like the risk reward that you go into it, just like you do every trade that you put on, right? So hopefully that was helpful. The dollar, I think, is as I mentioned, the dollar and other FX crosses really important to have a key grasp on in terms of definitely should be on your dashboard, and definitely in terms of your watch list. And because the dollar in particular certainly drives a lot of, or influences a lot of other areas, both globally in terms of equities, fixed income, commodities, et cetera, et cetera. So, Chris, welcome, my friend.
Hey, buddy, can you hear me?
I can. Just want to give you a huge shout out on here. Again, I'm going to reiterate it that your conversation with Mike Green on Sunday was absolutely fantastic. If folks missed it because of Mother's Day and I did not really catch it live, I caught it last night when I was doing some notebook work. I would highly recommend you guys go listen to it. It was a fantastic, very thoughtful conversation, Chris. So just want to give you huge props for that. You asked some very, very amazing questions. Again, I texted you this the other day that sometimes your knowledge and your brain, the way it works, amazes me on multiple levels, dude. And I'm lucky to call you a buddy and a friend, and get to chat with you a lot throughout the day.
Thanks, man.
Yeah, man. Yeah. I also know you're British, so you're going to be blushing and probably really uncomfortable right now. So that's another perk to that.
Yeah, exactly. Yeah. So we'll skip that. No,
Yeah,
it's
perfect. We'll skip over that. What
no,
did you
Sunday.
want? Did
Sunday
you
was
you jumped
Sunday
up
was really good.
talking about FX though?
Yeah, no. I tweeted. I don't know how to work the thing. Trends knows how to add all the lots of stuff, and I don't know how to do that. But I retweeted basically my trend kind of view of crypto from yesterday. So people can go and look at that. Just to say that in terms of that space as well, it's very much the same as kind of an equity space where there's only 3 or 4 of the so there's like Ethereum, Bitcoin, Litecoin, a couple of the other smaller ones out of the kind of 75 that I track. So as we were coming into January and February, we were looking at like 70 of the 75 were all bullish as I view it in terms of how I measure trend. Whereas now we've only got sort of maybe 4 or 5 of them though, and the rest are neutral, and there's maybe 5 or 6 of them that are bearish, that are shorts. So just to say that the thing that's being seen in the equity market is being seen in other places. And I know, like Keith, I'm not sure whether he mentioned it on the macro show today or on the macro themes, but we all know it. We know that people call out all kinds of things when it suits their narrative, and then they don't. So, lots of people call out the fact that crypto leads the general equity market, only when it's bullish and everything's going up. They don't seem to call it out now when everything's weakening. So yeah, that's all I wanted to bring up, really.
Yeah, it's a good call. Yeah, no, it's again, I think if you look at today's price action, what was sorry, let me pull it up so I'm not misspeaking here. Yeah, I mean, you had NVIDIA up over 3%, Tesla up over 4%, and Netflix up, a little over 1.75%. Meta up 1.5%. Again, it's just like all these big boys are driving the space, but Apple's kind of just stuck. It's stuck. So even if you look at it from a larger picture standpoint, it can't even make a new high, right? So you got all these other kind of mega caps. And again, I'm not saying it closed at 172.69. So yes, it was green on the day, but that's not a new 3-month high. It's not a new 1-month high. It's not even and really it's not even the same high from August. So that's up at 174.55. So we're close to it, but it can't really even make that push higher while this 1% huge move up.
Yeah, exactly. It'll be interesting to see once. Keith will talk about it tomorrow, but all of my intraday data and stuff doesn't update till midnight. But it'll be interesting to see all the volume numbers and everything that come out from today.
Yeah, I mean, I saw decent volume today.
Okay.
Again, so it wasn't like a huge volume day, but what was it? So like S&P. Again, I track it on like a 5-day basis. So normal is like 21.5, and it was 23.9. So again, I can't do that math right off the top of my head at 5 o'clock on a Wednesday, but I could probably figure it out. But it was up a little bit. Commodities not so much though, which I thought was interesting, especially on oil. But yeah. So I think you're going to see probably like certainly a positive day over day on the volume side. But that 1 month will be interesting to watch. But yeah, it's a good call out, right? Because if you've got price at the top of the risk range, VIX volatility at the bottom of the risk range, and it was like relatively weak volume, that's a fucking green light. That's a green light on the short side.
Yeah, exactly.
Yeah. Hey,
So,
sorry, Trillion Capital. If you can hear me, you try to come up. It gave me like an error message. So if you want to try again, buddy, happy to chat with a great Canadian. But yeah. All right, let's try this again, Trillion.
Hey.
Hey, good, Trillion. How you
I'm
doing,
all
man?
right, thanks. Yeah, so I guess tomorrow we got Canada Goose's print, 6:45.
That's
So
right. That's
yeah,
right.
I'll have my popcorn ready for that one, and then I unfortunately,
I got McGough to get you an answer though,
oh, that
right?
was
Last
yes,
night.
it was absolutely amazing, absolutely awesome.
One of the perks of being in house, right? One of the perks of being in house. I can shoot Brian an email and be like, "Hey, Brian, we talked Goose. You got any additional
Well, tell him
insight?"
Pat, tell him
Anyway,
Pat.
I will. I absolutely will.
So yeah, tell him Pat thanks very much. But also, yeah, so I did get it on the Jets as well as Jay awesome call on Nutrien. That's also worked out extremely well. Um, and unfortunately, though, I have not been able to participate um, in the energy shorts. Though I unfortunately, but I mean just brilliant calls, amazing research. I just wanted to say thank you so much for everything, guys.
Oh, absolutely. No, I appreciate that. It's very kind of you. Yeah, energy. Energy's been. Listen, energy, industrials, and financials have been. If you put those on in the last month, I mean, you've had a great month on the short side, right? If if you didn't do that, then let's work on getting better together. But if you're listening here and or listening to the macro show and you're listening to macro themes, I mean, these are key areas that the cyclicals, small caps, bad balance sheets, profitless tech. I mean, IWM's been another great one, right? I mean, let alone KRE. But yeah, no, thanks, Trillian. I appreciate that, and we don't need to kind of go back and hash through a bunch of winners because we really want to prepare for next next week, next month, that kind of thing. And not to kind of just repeat myself from the last 45 minutes, but I think you really had a really great opportunity here, top of the risk ranges on some key stuff. The consumer discretionary to me was like an absolute slam dunk in terms of on the short side. It was right at the top of the risk range. Again, if you can kind of zoom back, big lower high here at like 150.5 versus back even in February where we got all the way up to kind of 157-ish level. And yeah, I mean, you got Amazon, Tesla, that that really kind of led the charge. Certainly this morning, Tesla was finished up almost 4.4%, and Amazon was like 1.85. So that's a huge component of consumer discretionary. And inside of that, you also get the added bonus of Home Depot. So I think just to kind of expand on that thought a little bit, seeing Home Depot come back on the board from Coach in real time alerts, and seeing him go after PP, right? So again, like PP is hard to borrow. I get that, but some of his top longs are Tesla, and I think even Amazon. But I know Tesla is one of his top longs. So when you see PP, that's like Coach's way of saying short this profitless tech bullshit, right? So if you can't trade PP, go find and go hunt around something that's holding. I'll tweet it out later. I'll do that tonight, and just because I haven't looked at them in a month or two. But yeah, I mean, he went back to the board on Microsoft, hit the button on XLY as well, and IWM. So again, when he starts kind of loading up on some of the sector shorts, and these are core shorts, right? XLY, we've been short since February, I believe, last year. So it's been a great cycle long short, but we haven't really been there in the last month or so, which has been a good decision because it's been up a relatively basis, right? It's been kind of flat versus really pounding the table and getting short and adding to things like industrials and energy and financials. And again, this was like a great opportunity to kind of go back to the wood on those, as well as go back to some of our core shorts like consumer discretionary. All right. I'm sorry, I'm fighting allergies, and I think I picked up a little cold for my kids. So I apologize if I'm a little nasally. It's been, I feel like Chris, I kind of feel like shit this week, to be honest. But it's just like all in my head. It feels like I got like a brick stuck up in there. But we got probably another 15 to 30 minutes before the kiddos come home, and I got to go do some dad duty stuff. But so if you get anybody else out there who's got questions, again, I see a lot of really wonderful, friendly faces. If anyone wants to ask a question about the process, about what we're seeing on the page, share what they're seeing. It's a big global market out there. I'm sure I've missed some stuff. One area I guess we didn't totally hit on, and Chris, you can chime in too, because I know you do follow volatility obviously quite closely, but the underlying volatility across the board. So whether you look at MOVE, high yield, VIX, RVX, VIXN, gold volatility, aka GVZ, oil vol, OVX, if you kind of peel the envelope back a bit and take, sometimes I like looking obviously day over day to track kind of what's happening, on a daily basis. But then in our macro show deck, we also give a multiple slides where we track day over day, week over week, and month over month. I think looking at the month over month really helps kind of look at what's happening on more of like a trade duration, because as I mentioned earlier, trade is 15 days or less. So month over month is typically, call it 21 days. And there's a lot of positive momentum, I guess, right? So like basically volatility higher than where it was a month ago. I mean, the MOVE is up almost 5%. High yield's up 8.5%. VIX is up 9.3%. RVX is 9.9. Now, again, these were this morning's numbers, so forgive me, but go take a look at this morning. VIXN is actually down month over month, minus 6.6. So again, another key reason where we haven't been as like active in putting back our core short in news or the NASDAQ. Volatility has kind of decreased. It's gone from, let me pull it up actually, I think it's gone from about 24 in the last month down to about 19. Where was it a month ago? 21-ish, 21 and a half. Hit a high in kind of end of April around 23 and a quarter, but it doesn't matter. But my point is that kind of looking at these numbers really does help kind of dictate, where, this volatility, again, VIXN's putting in lower lows in terms of, new 1 month low today, I believe, and another new 3 month low. But if you look at like VIX and RVX, those are putting in, higher lows, right? So not even close to the lows from the end of April there on both VIX.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between, with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
Trade trend higher, and these higher lows are quite important. I don't know if you got any commentary there, Chris.
Rob, we just cut out for about the last 20 seconds, and I think...
Oh, my bad.
I think Jody just got in the car because you started coming through as the audio from...
Oh, no way. All right. So she must be home. So is that my cue to... No.
So she's home.
So she's home.
Outside,
all right.
Yeah.
Good to know. So you heard my kids. I think we're back though, right? Can you hear me though?
Exactly.
All right. So my point on the volatility is that it is making higher lows on the equity side, and the MOVE index. The MOVE index is trying to make new lows, but it's not there yet. So that fixed income vol is still exists, although it's not 200 like we had a little less than 3 months ago. It's certainly still elevated, and that equity volatility is putting in higher lows, which is really kind of trending higher. So it's kind of like this slow build, in my opinion. And the actions that Keith is making is kind of echoing that same thing. I don't know if you seen anything differently on the vol space there, Chris?
No, I think it's just the same. Well, it's sticking to the MOVE for a minute. Obviously, it's weighted, so the VIX is just using 30-day S&P options, but the move is weighted across the curve. So what was it, 2s, 5s, and 10s, I believe.
Yeah, I believe that's correct. Yep.
So with regardless of whether there's pauses or one more hike, whatever, the reality is that it's potentially, if there's another hike, it's a 25 basis point hike, whereas before, especially as the move, was really ramping higher, it was when 75 basis points and 50 basis points were still on the table, right? So in that way, volatility has reduced, because whether a hike is coming, at least the size of the hike is much, much more reduced.
Yeah, that's a good point.
But in terms of volatility overall, yeah, it's pretty much the same. It's just, obviously there's a bit of nuance. Like, you can trade the VIX, you can trade VIX futures, but you can't trade like something like VXN or RVX. So they're good indicators if you don't have access to other things, but yeah, they're I'm not really sure how much signal there is in them. They're a good thing to have if you don't have anything else. But yeah, so in terms of the not so much in individual names, but obviously the shorter term options are having a big impact. So, I've said this a lot. It's like you have to be careful. I mean, it's quite.
I just pulled up 9D and 1D. I got both on my screen, but yeah, I mean, VIX 90 is down at under 15.
So yeah, you just have to and again, the VIX 1 day example is, again, it's helpful in some ways just to use as a marker, but just in the same way that the VIX uses, it basically has to mold depending on how many days there are in the month. It takes a weighted measure of the front month and second month contract, and the VIX 1D does that. But instead of being like a month long, the window is just 1 day. So by the time it's closed tonight, it's using 100% of options that will be priced as 0 DT tomorrow, and then by the middle of the day, it then weights between a 50% weight into those that are expiring today and 50% of those that are expiring tomorrow. That's why the moves are just so massive. So, and it's every option. It's not within a band, even though you've seen, like, over the last few days, the VIX is moving within a really tight band. But everyone that's like, it's obviously been the big thing about 0 DT is like a manipulation and blah, 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 blah. The reality is if you buy a 1 year option 1 year ago, then today it's 0 DT, because there's 0 days until it expires, right? So 0 DTs have been around as long as there's been options, because an option expires, right? And as it gets closer and closer, it was a 250-day DTE. Now it's whatever, a 20-day DTE, and now it's a 1 day DTE, and blah, 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 right? So they've always been here. It's just obviously the trading in them has been much more. So the other point is that all of those options, so if some option was struck 3 months ago and someone bought a 3,600 put, then even though we're up at 4150 and the S&P's been trading in like a plus or minus 50 point range, that 3,600 put is still 0 DTE, and it's counted in that calculation. So that's why it just swings all over the place. So it's not only that, it counts every option that's now counted as being zero. Excuse me, it counts every option that's now counted as 0 DTE. Bloody hell, can't speak. And it has to do this weird balance in between, because obviously it's only looking at 1 day. So yeah, it's a bit of a crazy metric. I hope that's made some kind of sense.
Yeah, it does. And I have not paid as much attention to the 1D, but have kept an eye on the 9D, which I've been doing for a long time, well, ever since you really introduced it to me. Am I doing a disservice to myself, or is that I just find the 1D a little noisy, which I think you just kind of mentioned. I mean, I guess it's like, I mean, I look at it, but I just don't have it on my watch list as like on the 1D.
No,
but I guess with all this,
no, it's too noisy. There's
yeah.
If you're trading that short term, you'll have all of your options data open anyway, and you'll have the implied vol for everything open. So if you're not trading at that shorter term, then it's really just it's too wiggly a wiggly line.
That's I had it up for a while, right? When it kind of first came out. What was that? That was about 3 weeks ago or so, a month ago. Might not even that long ago, to be honest. But whenever it came out, and it just for the first like two weeks, I guess, I was just like, I had it up, and it was just like too much noise. I try to minimize the noise, as you know, Chris. Yeah. Cool. All right. Well, think stack grow. You popped up. I appreciate it, my man. Hopefully, I believe my audio is back. You are on mute though, so if you don't mind unmuting yourself, there you go.
Hey, can you hear me, Robert?
I can. It's been a minute. Welcome back to the program.
Yeah, thanks. First of all, I hope Jody didn't lock her mom in the car. They both are okay.
I love that. This is awesome. I love. She's gonna be so mortified that she like switched to her. She's literally gonna be mortified. It's gonna be awesome. Anyway,
it was pretty cool to hear. It was pretty cool to hear. No, it's just first of all, how awesome is Coach? I was looking at the tape throughout the day, and you could only think about one thing. They really want their bubble back, don't they?
Oh yeah.
It's just everything kept pushing towards the top end of the range, and the walls just kept getting suppressed. It was like an I don't know, you would call a quad 2 or a quad 1 day when everything besides the huge, the staples and healthcare is at the lower end of the range, and the rest they just keep pushing at the top. But it really seemed like that.
Yeah, I'm going to be very interested. You just brought up something I haven't talked about yet, which is the eyeball. I'm going to be very interested to see where those eyeball premiums discounts land in the morning once Richie has all the new data, because I suspect that the spot, maybe not on SPYs, but certainly on some of the other components that were, like XLK, XLY, XLI, XLF, they've all been kind of, traded, basically everything's had a premium. Almost everything's had a premium recently, other than XLC, I believe, this morning. XLC, I think, was the only thing that had a discount in terms of like the core kind of US, sectors, equities. But it's going to be interesting to me where I'm very curious to see where they landed, because I was seeing it to Chris's point, kind of in a lot of the implied volatility, that I track all that kind of stuff, right? But it'll be interesting to see kind of where they land and like where they land on the Z score, because I think it was a pretty damn good opportunity from an eyeball disc, like kind of certainly from an eyeball standpoint. But we'll have to see. We'll see if what I saw on the board, shakes out in the morning.
Yeah, some Z scores have been crazy. I mean, you see the SPY is still pinned at plus 2.3 on a 1 year Z score.
Yeah, and Qs are plus 1.9, right? Like, so it's been quite they've been quite elevated.
Yeah. One observation I just wanted to point out for reference. I know we measure it on a multi-duration week over week, month over month, but I think where Vixen closed today at 1916 is pretty much the same level as it was in the end of October 2021. And the quote unquote the bubble cap, like Microsoft, Apple, and Qs, I think they peaked at around Microsoft and Qs. Nasdaq peaked around 22nd of November, and Apple the first week of 2022. So, when you hear Coach in the mid-quarter macro theme presentation updates, like it can literally fall apart any day. And you look at the vols and you look at the risk ranges and you look at that, Microsoft risk range going sideways. It kind of all ties in together. It's just the one way that I see it.
Oh, it's a great call out. I think, I have shared. You're 100% correct. I think I shared that maybe last Thursday. I will have to go find the tweet. But yeah, that Vixen, you're absolutely 100% spot on. I just pulled it up. I didn't have the like kind of 5-year look back or kind of like the longer term look back, but yeah, you're absolutely correct. It was October. We're basically back to October 21 levels, and prior to that, it was kind of hovering around here in that late summer. Pretty much all summer, it kind of fluctuated from kind of 19 to 22 of 21. So yeah, man. I mean, that's a great call out in terms of it made a new 1 month and 3 month low today, but it is back at the levels of late 21, which
late 21.
What could go wrong, right, buddy?
And it's like it's one thing, it's one thing that it just touched it, stay there for a cup of coffee, and move back. It's like it was pinned over there because it was quad 2 before it just started ramping back up as the stocks peak. But it's kind of like the same thing with Vixen, and the whole edifice of at least the bubble cap they're pointing towards. They keep going high, and where the rest of the market just don't care. Another just quick observation. I looked at that. I only started to actually see it yesterday, but when you look at the Bitcoin risk ranges and when it started signaling lower lows and lower highs, I think that the dollar correlation started to be picked up with Bitcoin around 9th or 10th of May. And, it's that sneaky little dollar, man. It's just started picking back up, and day over day, it's back to, like today, it's pretty obvious when it just gets dark red in the correlation table, but it was spot on.
Yeah. Yeah, it's kind of uncanny how that happens, right? It's like it's freaky. Yeah,
absolutely.
No, it's a great call out. That's a good call out. So again, if you're short Bitcoin, so the point there, right? Thanks, Zach, is that if you're short Bitcoin, it's not at the low end of the risk range, but you got a high correlation to the dollar. The dollar is basically at the top end of its risk range. So the process would have you lightening up some, right? So covering some. You're not covering all, right? But you're covering some. So that's a great teaching point there. And I believe is Jay, isn't it? No. What's your? I will just keep calling you Think Stack. It's fine.
It's Raj.
Raj. Sorry, Raj.
Yeah.
I knew it was. I thought that was my next guess was going to be Raj. But sorry, man.
No worries.
Yeah, it's a great teaching moment. So thank you for bringing that up. Because it is not just one thing, right? It's not just about like where Bitcoin is in the risk range. It's where is it in terms of dollar correlation? Where is it in terms of the CFTC futures contracts, right? Like who's long it? How is consensus long it, short it, all that kind of stuff, right? There's so many different pieces that go into the toolbox, the puzzle that make up a decision in terms of either trimming some, adding some, et cetera, et cetera. And it's not just Bitcoin; it goes across the board.
Right, and especially, I think, Robert, I've noticed, especially this gets even more important when it comes to Bitcoin, because it's one of those assets, where it doesn't fall, 1 to 2% being a high vol asset. It's just one morning you see, and it's got 6% down, and then the risk range is suddenly winding up, and all correlations are at the top. So you gotta have to monitor day over day to see, it's making lower lows, not making higher highs, and as you said, connecting to the other points, it could literally go on a waterfall, and you won't know that.
No, yeah, exactly.
It's like the opposite of dollar, where you can really rely on the low vol, and you can easily trade in between. But with this, your heart says, you can capitalize on a massive up move or a down move because of vol and risk range widening. But then you get caught on off guard, and it's all done.
Well, and it goes both ways too, right, Raj? I mean, it
Right.
goes, and that's one of the reasons why we preach, volatility adjusting your position sizing, and that goes for both longs and shorts. Because with a high volatility asset like Bitcoin, right? Like it can go up 50% just as easily as it could go down 50%. And so, it's really important to like kind of size things appropriately so that you're not, you're protecting your capital. Same thing goes for like zero DT options, right? Like if you're going to trade zero DT options, I'm not saying don't. I mean, I trade some zero DT options, but like it's all about the right sizing and making sure that you're not kind of outsized, from a risk management standpoint.
Absolutely.
Yeah.
I'll say I've been more successful at zero DT than any other duration. I just suck at options, man. It's just like the free money I give to Robinhood every now and then, and I should probably stop. I did have a question, Robert.
Yeah,
I know
go ahead.
you, coach, probably have explained that multiple times, but how do you define a lower high when he comes in the morning and says it's making another lower high? How does he define that?
Yeah, that's a good question. And really, unfortunately, like many things, it kind of depends, right? So that you can talk about it in different manners. So if you kind of zoom back a little bit, right, Raj, and we look at more of kind of like a cycle to date, you can talk about it from a lower high on a kind of like longer term look back, right? But typically I'll just refer to what when I say stuff is kind of lower high or higher lows here on the notebook review. That is typically on a day over day basis and then a week over week basis. That's usually how I will look at things in terms of what's transpired, and that's purely just the risk range. So if I use SPX as an example, let me get 510 here. By the way, my notebook, I'm going to take a picture of this later tonight. I spilled coffee on my computer yesterday, and my notebook is an absolute disaster, but it's actually kind of amusing at the same time. So I'll share it out with everybody later. But it is extra crinkly right now. So the top end of the risk range is 4154 on the S&P this morning, and then yesterday was 4170. So that's a lower high. And the low end of the risk range was 40.54 yesterday and 40.55. So technically that's a high or a low, but really, kind of a point there, it's kind of up to your discretion. I would call that kind of like unchanged, really. That's just sort of like kind of just a little noise, but definitely a lower high where it was 41.70 yesterday to 41.54 this morning. And then if we go back to last Wednesday on 510, I believe that was last Wednesday, you had a low end of the risk range of 40.41 and a top end of the risk range of 41.49. So on a week over week basis, you have a higher low and a higher high. So a little bit. So again, I look at that threshold because I want to see kind of where we come from, kind of week over week, and then where what is the day over day kind of like price action looking like, right? So so that's kind of how I look at things. I think Coach Keith will review things again, from multiple kind of durations on both a day over day basis. That's usually how he's referring to it, from kind of a lower high, higher lows, and that scenario is more of a day over day basis typically. But sometimes he will also refer to it more from like a cycle to date standpoint. Like for instance, I'll just use like crude as an example. When it put in, a lower high back in kind of like mid-April at like 82. If you go back to like the cycle peak of 120, that was another lower high, because like the next sort of levels were that kind of like 95 level, and then kind of 92ish, and then basically 83 and change back in mid-April. So that's again multiple durations there, Raj. Does that make sense?
Absolutely. Yeah, it
Okay.
just when he says a big lower high or a big higher low, that's when I start looking. It's like, okay, where's the big part? But it absolutely makes sense.
Yeah, so like S&P in my notebook today had a big LH next to it, which means big lower high, because that was like a 16-point drop. And on a day-over-day basis, that's a big deal. I mean, again, it's it's not math. Like I'm not like calculating the math, right? So like don't like, but
No, but I
um,
understand. I think with respect to the vol of something like S&P, when you see such kind of a drop, it is big.
right, especially at like vol vol closed yesterday. I think VIX closed around like 7, yeah, almost like 18 yesterday, I think it was. And so yeah, so again, like on that component, right, the 16-point drop, really just, yeah, like I was pretty bared up coming into the day. So I think that's probably why I also felt like I got kind of run over by a truck, because I saw that lower high and I was like, oh, awesome. This is exactly kind of what I was looking for. And I saw, excuse me, and I saw a higher low in the VIX at 1611 versus 1607 yesterday. Now the top end of the VIX came down, but that's more of just kind of like the vol coming out of that entity. But yeah, man, I was coming into the day, I was ready to short, get short, and then as I said, I did at what I thought was pretty patient levels, and I just got even better pricing come the end of the day.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager-in-chief, Keith McCullough's macro overlay. Our team of 40-plus equity analysts discuss key market developments, trends, and our high-conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
It's a great
Thanks.
Great show,
Yeah.
guys. Just I had
Thanks,
a very
Michael.
quick question. It's
Yeah, by all
very
means.
enlightening. With Quad 4, does that entail a deflationary crash? That's my first question. And my second question to follow up that would be, then wouldn't a dollar rally and a dollar breakout be a component of this deflationary crash that we're looking for? Thank you.
Yeah, good question. Absolutely. So I think it's less deflationary and more disinflationary, aka lower levels of inflation, but still elevated on a historical standpoint. So if you look, and we actually published new models today. Let me pull it up so I'm not misquoting, because these numbers have been shifting. So give me 30 seconds here. It's like slide 15 or 14, I think 15. So if you got the macro themes deck from today, if you're a Macro Pro subscriber, you can go to slide 15, and this is where I'm getting this information from. So Michael, to answer your question, we're forecasting, or now, in our nowcast model, we have 4.26 as our estimate for inflation, US CPI on a year-over-year basis, so 4.26 in Q2, and then that dropping to around the 3.5 level, kind of throughout the next three levels. Technically, it's 3.57, 3.46, and then 3.47 over the course of the next 3 quarters. So if you look at it, historically, that is still an elevated level of inflation. But when you look at it from a rate of change standpoint, from where we've come from, aka the peak of Q2 22 at 8.63, that is a deceleration in inflation, so a deflationary environment. But again, as I mentioned, I think there's nuances there to your question, Michael, where it's still elevated historically, but disinflationary, or from a rate of change standpoint, decelerating on a kind of a quarter over quarter basis. Certainly, last quarter, which was 5.81 to 4.26, and then again in Q3 there at 3.57. Now, again, those are our nowcasts. But I think where we really differ from the street at the moment, consensus estimates in Q4 have inflation dropping down to 3.2, whereas we're at 3.46, and then really the delta there is 2.8 in Q1 of 24 versus our current number of 3.47. So again, this is a big component here where. In our outlook, so we got a quad 4, which we have a very high conditional probability of happening here in Q2 of 23. Then it becomes a bit of a coin toss in Q3 and Q4. But at the moment, I'll just kind of quote what's sort of has the highest probability at the moment, which would be quad 1 in Q3, and then a quad 4 in Q4, and a quad 3 in Q1. So so again, from a dollar standpoint, the dollar loves quad 4, and gold loves quad 4 and quad 3. So this is where we've kind of we are no longer sort of like, I guess, officially long the dollar. We sold our kind of final dollar position a few weeks ago, but we are still long precious metals. And one of many reasons, or one of the reasons, is because of the kind of nowcast quad outlook that we have on the horizon, and where gold back tests and historically performs really well, which is in quad 4 and quad 3 environments.
Okay, thank you. Appreciate it.
Yeah, absolutely. And then from a growth standpoint, just to kind of finish that off from like the whole quad landscape, which is a growth inflation and policy model, so a GIP model. The piece here that Coach Keith McCullough has been really sort of hounding on the last couple weeks is the fact that growth there is slowing, right? So this is where our recession risk rising, I think, is something that I've been pounding home to everybody, and that's because we're looking at, from a nowcast standpoint, of a growth around basically 1 to kind of flat, right? Or like around 1%, call it, right? For the next kind of like four quarters. So this is a big piece of that puzzle, where you're going to have growth, although might be accelerating. So that quad 1 environment in Q3, for instance, that's an acceleration in terms of a rate of change standpoint, but we're going from what we're seeing in the nowcast model from 1.0 to 1.25, right? So it's like so it's still a relatively very low level of growth. In conjunction with that, inflation continuing to decelerate slightly in Q3. So that quad 1 might look a little bit different than more traditional quad 1s, where you do have decelerating inflation and accelerating growth to a much higher degree, right? So I think this is going to be a really interesting kind of quad 1 environment in Q3 as we kind of approach that. But then back in, and again, like that's why the nowcast, it's a bit of a coin flip, because it's it's a 25 basis point increase on growth quarter over quarter, and then Q3 to Q4 right now the nowcast model is 1.10 from a GDP year over year standpoint versus in Q4 versus 1.25. So you're talking about like a 15 basis point decrease. So again, so I think there's so just to give you kind of a full complex there in terms, or full view in terms of what's influencing the GIP model, the nowcast model, our quad outlook, and that kind of thing. Hopefully that's helpful. I think you're on mute, Michael, but I'll just take that as a yes.
Just to add on that, on the dollar, that you have to remember that the dollar doesn't exist in a vacuum. So the reality is that, like here in the UK, inflation and rate rises and everything, so you've got the relative differential between the interest rates. So currently, whatever's going on, some kind of pause from the Fed or whatever. But the reality is everywhere else, you've still got huge inflationary pressures. So those central banks are still under pressure to raise rates. So you're still going to continue to have the rate differential, which will force capital to go to those higher interest rate currencies. So until that shifts, and again, it doesn't have to be a nominal shift, it just has to be the rate of change has to move to the point where
I don't have it in front of me. Yeah, it's a really good point, Chris. I don't have it in front of me, but I know the EU came out with their CPI number today, and I think it was north of 5.5%, if memory serves. So it was a big number, and you're absolutely spot on. And I think
so here in the UK, well, maybe it's about 6 months. It was joking that we're going to have to put like what would you call it in the States? A magic marker on the shelves for pricing things. But I think it's getting to the point where that actually might be a reality. So they might have to run around the shops and say, "Oh, the 3 potatoes that are left are now £50 each."
Right. Yeah. Yeah. No, yeah, it's a really good point. The dollar certainly does not live in a vacuum. But yeah.
And just get to, I didn't catch his name, sorry, to Think Stack Grows question.
Yeah, Raj, yep. On
just
higher lows and lower highs type thing.
Yeah, just remember, well, I don't strictly know that this is how Keith does it, but if you're using some kind of look back window, what you have to always be conscious of is that, let's say, today, the whatever market you're measuring the volatility of, and it went down 3%, which was a big move for that asset, whatever it is, right? And you're looking to measure the volatility. So that was a big daily move. The converse is that if you're looking at a 20-day window, just as much as you have to look at the price and what it's doing today over those last 20 days, what you also have to be conscious of is what price moves are falling out of that. So what price is going to become, day 21, meaning it's not going to be in your look back anymore. So me and Robert have talked about this a lot, that the change in vol of your look back window, whatever it is, or whatever parameter it is you're measuring, is affected just as much by the days that are leaving, or the data points that are leaving your look back, however big or short that is, as much as what's going to change with whatever the price move was today. You have to always look at what's going to fall out the back too.
Yeah, phenomenal point. So I'll just use an example here, Chris. If folks at home, if you pull up crude oil, so like CL1 for the futures, that's what I'm looking at currently. If you look at the 15-day window, so like if you kind of go back in time there, the high tomorrow in that 15-day window was 76.78. That's the closing high. Come Friday, that's going to fall out of that. That price is going to fall out of the window, and then it's going to go to the next day's low, or sort of closing price, which was a down day of 75.66. And then come next week, you're really going to basically your high prices are really from the last 10 days, which was May 10th, I believe it was, at 73.71. So basically come next week, crude's like 15-day window in terms of just like from 15 days to today, it's going to look a lot different from incorporating, higher prices than it will come Monday. So so go take a look at that. I think it's helped me immensely when Chris and I learned a lot from Chris, if you guys haven't noticed. And he's an incredibly intelligent dude. And so
if you use
so
if you use the S&P, or I've got E-minis here, right?
So you're using E-mini, so ES?
Yeah, so if you're using like a longer time frame, if you're using like a 3-month window or something like that, then all of those prices from early March, well, the middle of March, really.
Yep.
Like down at 3,800-ish.
Yeah. 3,900. Yeah, exactly.
So as we move through time, all of those prices are going to fall out of your look back window. So the kind of high and low points are just going to keep compressing and compressing and compressing until we move through time. And that's where I've talked about before, is depending on whatever metrics you're using to measure these things, is so that in terms of like, if I'm thinking of like some kind of trend levels or trend lines, what it's doing is it's compressing those trend levels as those old prices are falling out the look back. Excuse me. So what it means is the price is mechanically moving closer to a break, either to the upside or to the downside. So it just means that, well, I said it at the beginning, you need to pay just as much attention as all of the data that's falling out of your look back that you're looking at, as much as what it's doing today.
Yeah. It's like the new data that's coming in. Yep.
Exactly. Yeah.
Yep. Well, I think that was a fantastic way to end it. What a coaching note there, Chris. Well done, my friend. No, seriously, great job. Awesome. Well, yeah, I think we are going to wrap up. Unless anybody that's up here on speaker has any follow-up questions, either for Chris or myself. All right, perfect. Well, another great session. Thank you everybody for joining us, for listening. All the speakers, really appreciate you guys jumping in and taking this conversation to the next level. So thank you very much for your participation. We'll be back next week, same time, although Gavin is asking for a late night session. So we may push it, may do like a special kind of, 8:30 time frame. I'll touch base with Gavin. So if it's not next week, then anyway, I'll keep everybody posted. But we'll be back at it next week. Good luck out there, and keep executing on your process. All the best. We'll see you soon.
Thank you so much. Thank you.
Absolutely. Thank you.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.